Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent, licensed in all 50 states, the top independent agent in the country, and proud of that because I only look at contractual guarantees. And our saying here on the Fun with Annuities podcast is live in the reality, not the dream. Live in the contractual realities. By the way, welcome to everyone that's watching this replay on the Fun with Annuities YouTube channel, and welcome to all of you listening on all of the podcast platforms out there, Podcast, Stitcher, iTunes. I'm sorry if I left someone out. But without further ado, we have a repeat guest on because the last time we had him on, it was a firestorm. People wanted to ask questions. They emailed questions in. Agents sent me emails that were hateful, that's a good sign, by the way, when they do that. Now, this guest, as you know, we've had him on before. We call him Mr. FIA-X. FIA stands for Fixed Indexed Annuities. This is a person we cannot reveal his identity or where he's located. He's got a mask on for a reason. For the people that are listening on podcasts, he has a mask on because the people on the Fun with Annuities YouTube channel, he can't show his face. But boy, is he an insider to the game of indexed annuities. Now, as a disclaimer, I sell a bunch of indexed annuities, but I sell them a different way. I sell them for the income rider, contractual guarantee for future income. We really don't focus on the accumulation value because that's where the sales pitch nonsense gets in the way. Now, the topics we're going over today are actually from what people emailed me and called me and said, hey, next time you have Mr. FIA-X on, ask this. So without further ado, the one, the only, the confidential Mr. FIA-X.
Well, with that introduction, I can't let you get out. So there you go. How's that? I want to start off because I have a question because you're going to love this.
Okay.
I got a phone call last week from a marketing company. And as you know, in our industry, people call you with marketing companies pitching, selling their wares to you for you to represent to the clients, right? The opening line was, we have a brand new indexed annuity that has averaged 9.5% for the last 10 years.
That's a flat out lie.
This is where the laughs came in. If it's brand new, how did it average 9.5%? See, that one would slide by the layperson, but this is what I have done. So I sat there and I'm like, well, how does it, basically, if you're telling me it averaged 9.5% for the last 10 years, I'm 10 years too late, is what it sounds like.
No, absolutely. Hey, by the way, Mr. FIA-X, I need you to yell or get closer to the mic because the people.
I'll do my best, but they.
That's it. Whatever you did right there, lean in, brother.
Okay, so they told me 9.5% average for 10 years and it's brand new. I'm like, well, if it averaged 10% for 9.5% for 10 years, it's brand new. How does that work? I'm confused.
We talked about the back tested, and why don't we just start there? One of the things that Mr. FIA-X and Stan the Annuity Man, two very unique names in the annuity industry, but beloved, we hate the back tested stuff. I mean, in a lot of states, it's not even legal to show back tested numbers, and I wish it was across the board because that's where agents can juice the numbers. So if anyone's out there saying, well, if you'd have owned it 10 years ago, you would have made this. Or like Mr. X just said, well, this is a brand new annuity, but if you'd owned it for the last 9 or 10 years, it'd have made X. I'm just telling you, if you're that dumb, and if I'm offending you, I apologize. But if you're that dumb and you're the sucker at the table in Vegas, you know what they say, Mr. X? If you don't know who the sucker at the table is and when you're sitting in Vegas, it's you. So
you're not for us. You're not, you're not for I wouldn't work with people like that. And I know you wouldn't either. You just can't.
Well, but people want to believe it's true. People want to believe that they take the pill, they don't have to exercise or diet, and they can get skinny. People want to believe that they can just put their money in Bitcoin and retire, right? I mean, there's a reason that Ponzi schemes proliferate the United States, and by no means annuities are not. Annuities are contracts. It's a heavily regulated industry. And that's the reason I say buy the contractual guarantees. Mr. X, the first question that came in was we are officially in indexed annuity silly season. And what that means is there's a lot of annuities out there being pitched with what's called upfront bonuses. Now, Mr. X and I do not mention any carrier names because we just don't. We're pros. We're not going to do that. And plus, I represent everybody. I don't want to make them mad. But Mr. X, I call upfront bonuses candy for the stupid. And I mean that. If you're buying an annuity for an upfront bonus, it's like buying the car for the stereo system. That's how stupid it is.
Well, imagine going to the bank and you gave the bank $1 and they gave you $1.20 back. How long would that bank stay open?
Great example. That's a great way to put it.
They're not giving away free money. They're not just a charity. They are a company that makes a very nice sum of a return on their investment for taking in these dollars. It doesn't work that way. Okay. The reality of the deal is I call it shiny thing, candy for the stupid. You can put whatever moniker you want on it. It is a gimmick. It is a trick. It is a sucker's bet. It's a way to pull you in because I can assure you and promise you this. Two things are going to happen. Number one, the money's not real. Number two, if the money is real, they are going to just keep chipping away at you over the length of the contract to recover that money, meaning you will get less participation, a lower cap. You'll just get a lower rate of return. They have a bunch of levers and they'll just pull a different level for the term of the contract till they recruit what they have, and thus they have the big, huge building with all the people in it. And that's how the game works. If the agent says, well, this company is giving you X amount of bonus, and I want to be careful because I don't want to offend any companies and get nasty letters.
No.
Well,
they don't know where to send yours. They know where to send mine.
If they give you X amount of money for a bonus for you to put your money in here, and we're going to give you all this cash up front. Seriously?
I mean, yeah. There's no philanthropist at annuity companies. Mr. X, I need you to get really close to the screen because people want to hear you. All right. So yeah, plus they want to see the mask. By the way, for anyone that's watched the TV series Mr. Robot, what is that? Is that the anarchy mask? What is that you have on?
It looks like Salvador Dali, doesn't it?
No, it's good. It's actually better than I actually know Mr. X's original face, which I'm kind of happy we do have the mask on. But bottom line, and to close it up in a nice little bow, give people your upfront bonus definition using your 100 pennies and $1 definition.
There's only 100 pennies in the dollar. How can the company give you 110, 115, 120, 135, or whatever cockamamie number they throw at you? The second part is, where does that cash go? That alleged bonus, where does it go? Right. They typically put it into where? The income account.
Correct.
Now, some will go into the cash account. I'm going to break these down separately. If they go into the income account, Stan, I've heard you say this 1,000 times, the income account's funny money, play money. All the income account does is create some fake number of cash that they allow you to multiply by a percentage to withdraw from your cash value. And
that's a good thing. That's how we we recommend income riders, and we shop them all for the highest contractual guarantee. That's what he's talking about.
Yeah, it's irrelevant what the number says. It's what the guaranteed payout is. Not what it could be, not what it could grow to, not what it could step up to. I want to know contractually. Think of your mortgage payment. Well, contractually, your mortgage payment's almost like buying a variable mortgage rate, right? Your payment's this today, but next year it could be this, it could be this, it could be that, it could be all over the board. We don't know. I want to know what I'm paying. Period. And
exactly.
As an annuity client, I want to know what I'm getting. Period. End of story. I don't care what the pie in the sky is. What's the paper say? What's the contract say? What's the guarantee say? What's going in my checking account? Could it be more? Great. I want to know what I'm getting.
And these bonus products are very, they proliferate the bad chicken dinner seminar circuit. So those are coming back because COVID's being lifted. And if you're going to the bad chicken or really good steak dinner seminar, they're going to pitch you a bonus product. And you're going to elbow your wife or spouse and say, man, that sounds good because they're giving us free money, Marge. No, they're not. Mr. X is nicer than I am. He says they're shiny things. I say bonuses are candy for the stupid. I'll leave you with this great story. Somebody bought an income rider from us. We shopped all carriers because they're commodity products for the highest income rider guarantee. He got his policy and called me up and said, Stan, there's 10% more money in here. You didn't tell me about the bonus. I didn't even tell him about it because I don't care. It's part of the overall contractual guarantee. And I had to explain it to him using Mr. X's 100 pennies in the dollar definition, which I have taken from him, but I do not pay royalties. Yes, actually I do. When I see him, I buy him drinks. And that, by the way, that's an expensive royalty. But I'm just telling you, it's not something to focus on, period. And if someone's pitching that to you and they're spending a lot of time on the bonus, they're either stupid, lazy, or a sociopath.
Well, I'll give one more quick analogy. I think this will rate. Think of a magician, right? When they always do sleight of hand and they take your watch, they're always wiggling their hand over here to distract you while they're pulling your watch off. That's exactly what the bonus is. It's the wiggle for you to miss all the other things behind it. I'm not saying that they don't work or they don't have a purpose to some degree, but what we're saying is, does the guarantee fit what you're trying to accomplish? If the guarantee doesn't solve what you're accomplishing, then you don't have a solution.
And if the contractual guarantees, the highest one is a product with a bonus, then great. If it isn't, then great. Who cares? And that's a lot of times, spoiler alert, when we quote all carriers, the highest contractual guarantee is not the one with this high chunky bonus. So I think we've done a pretty good job on that, Mr. X. Next question.
We don't want you guys to have to hear that word caveat emptor. Buyer beware.
Right.
Okay. Be
Right.
careful.
Right. No,
Do your homework.
I totally agree. Next question that came in from a viewer. Index renewals. They mentioned that the first year they had it a couple years, and it's never the renewal rate, the participation rate, caps and spreads on that accumulation value, the index option value, has never returned, okay, to that original first year. Explain what's going on, Mr. X.
Well, let's go back to that lever situation that we talked about just previously. So let's stay on the bonus subject. So you bought a bonus, and then in the year, it renewed at less money. Who would have saw that coming, right?
Yeah.
They gave you all this free money.
Yeah.
It doesn't seem so free now, does it?
Right.
So
a
what
lot
they do
of
is they keep
his
chipping
comment was
away.
the cap was 5 or 6, and now the cap is 2.
Well, they keep chipping away. They have to recover the bonus. They just kind of gave it to you up front. That's, about the easiest way to put it. So now they chip away. So that's one way they do it, Stan. The other way that they do it is obviously the price of the options. When they have to go do these index annuities, they buy an option in, say, the S&P, for instance. Okay, and we talked about this a little bit on the last call.
Mm-hmm.
Is if they put a cap on it, say 5%, okay? And when you go to the market makers, okay, to the investment banks, and you want to buy an option, there's no cap on the option, right? Options have an unlimited upside. They also have 100% downside too, right?
Right.
A traditional option. Well, what the companies do is they buy that 5%. What they do is they take from 5% over, right? 5.5, 6, 7. They sell that upside back to the investment bank. So now they're getting a discount off the option. So they're not paying as much. And they sell the upside away because why? What was the cap? It was 5. So you can never make over 5. So they don't need to pay for the whole option. They just need to pay for up to the 5% part. So what they do now is every year when you have, say, an annual reset, you have to keep going to the market and buying a new option for that year. Well, if the market's volatile, it'll cost you more. If the market's calm, it may cost less. So that's another pricing way to where that's kind of out of their control. I'll give the insurance company props on that one. what the market does is out of their control, and they just
Sure.
have to pay the piper. Okay.
But I tell people all the time, if you buy a 10-year surrender charge indexed annuity and you bought it for the index option, for the accumulation dream that's been sold, and it's a 1-year index option contract, then you're really buying a 10-year surrender charge with a 1-year guarantee. Am I missing something, Mr. X?
That's spot on. It's a 1-year guarantee. You're going to get a 1-year guarantee. Some of the companies have 2-year option, 3-year option, 4-year option. You're just going to get a 2, 3, 4-year guarantee.
Right.
And there's some other challenges with those, and we can get into that too. But the reality is that's just that one option. And every year they have to go reshop the market and pay what current market value is to re-up, so to speak. And then now remember, they gave you 20%, 15%, 10% upfront bonus. Well, all right, well, it was 5 last year. Well, if it's a 10-year contract and we gave them 10%, maybe we'll make it 3.5 or 4 this year. And then next year we'll drop it a little bit more, and we'll just recover that bonus over that time. And that's how they do it.
Are there and we've had this discussion, but is it still hold true that some carriers are very favorable toward the consumer on renewal rates, and some of them just bait and switch and stick it to you, not to mention names?
You know, I think yes and no, and everybody's going to laugh when I say that. Okay, I think some carriers are less favorable. I think some carriers are more favorable, but there's also more that goes into it than that. It really does sometimes play on market conditions.
Okay.
And the last thing you want to have happen is where you put your money to have financial problems. I wouldn't want my company where my money's at, and not that they do. They're back, they're regulated, they have all that stuff, but market conditions play a part, greed plays a part, profit margin plays a part. You know, all those things do play a part in it. So it's a myriad of factors that lay into what the renewal rate is.
Another call that came in, and they wanted you to clarify this. Bad Chicken Dinner seminar pitch was in Pennsylvania. Probably know who that person is. There's some bad dudes up there pitching stuff, and they're pitching uncapped, unlimited options on index annuities. Please shoot that down with a bazooka.
Well, okay, you could have it uncapped, but there's going to be what they call, there's a modifier somewhere. So I'm going to pitch this to you, Stan. You put all your money, put $100,000 in, you get 100% participation rate. It's 100% uncapped. Mm-hmm. No spreads, no fees, no nothing. Does that product exist? With a guarantee, mind you, can't lose your principal, can't lose your money. Does that exist?
Let me put all my money in there, Mr. X.
I'd be running down there right now to put my money in there if that existed.
But that's how it's pitched. I mean, honestly, that's how people are pitching it.
It doesn't exist. And here's, I'm going to defend the agent for a second.
Oh, okay.
Look at that blank look on your face. Okay. Wow. Sometimes maybe what they say may be misinterpreted. And that happens. People hear sometimes what they want to hear. That does happen.
That does happen.
If the way that I usually hear it and see it is they make it sound so grandiose.
Yes.
That the people heard right. They make it sound so grandiose that it is what it is. Look it. I'm going to tell y'all right now. There's no way, no shape, no how you can find an uncapped product with 100% participation rate with no fees. Just put your money in there and just let it run. It doesn't exist.
And if it does, we're going to stop the podcast. We're going to fly to Washington and meet with the Fed, and we've solved the problem.
We've solved a lot of problems for a lot of people. We'll fix Cuba tomorrow with that kind of deal. There's always got to be a catch, and instead of a catch, we'll call it a modifier or a stop gap or something. There always is something. If you have an unlimited upside, they're only going to let you play so much in that unlimited upside.
Mr. X, that's a t-shirt. A t-shirt is there's always something.
There's always, well, think about it. If I have an unlimited upside, maybe they only let me pay 30, 40% in that unlimited upside.
Right.
Because here's why. If they don't have if the consumer doesn't have a downside, right? Contractual guaranteed, you can't lose your principal, et cetera, right?
Right.
Well, let's say the market crashes. Say we have an 08. Who eats that loss?
No, exactly. It's not the consumer.
The company can't eat that loss for $6, $7, $8 billion a year or whatever they take in an annuity business. So there has to be some type of
when I say that the consumer's not going to lose any money, but the limited on the upside.
right.
And just a disclaimer again, people always say, "Well, Stan, the annuity man, you must hate all index annuities." I sell more index annuities in 1 week than 95% of all agents. But we sell them properly, in my opinion, and Mr. X has deemed it appropriate and blessed it as well, for the contractual guarantees of the policy and most of the time for the income rider guarantees for future income, because my saying is you own an annuity for what it will do, not what it might do. And the might do is about all these index option strategies. But I think it's important to have you on, Mr. X, because, it's one thing for me to say it, but for someone insider to kind of tell how the annuity sausage is made, I think helps the consumer. And the response that we got from your first appearance on Fun with Annuities was overwhelming, which is why you're on again. I think you're our first repeat celebrity guest. You should take that as a compliment, Mr. X. It's not your good looks, it's your good brain. Hey, here's another question. Give the people out there an example of a point-to-point index option with an indexed annuity.
Point-to-point is the simplest one to understand. You start at A. So let's say that the S&P 500 was at 1,000. Okay.
This is the contract issue date, right?
Contract issue date will say January 1st. The S&P was at 1,000. Whatever the S&P does to December 31st at the close of the market that day, because January 1st would be your anniversary date. So you go from point A to point B. Whatever it does, that's the return. So let's say the 1,000 went to 1,100. That's a 10% delta, right? 10% return. That would yield 10%.
However,
now you have to put the modifier on it. Is it a
Yes.
participation rate? Meaning how much of your money is actually participating in that? Is it a cap? Okay, that's pretty much the two ways they do it. Or they could give you a spread. All of it goes, they do a spread, and then you go from there.
just understand that what he's talking about, spreads and caps and participation rates, those are levers to lower the return.
Well, it's two things to do. It's a lever to lower the return, and it's a lever for the insurance company to hedge against the downside.
Right. Good point. Exactly.
So it serves a purpose, but you have to pay attention to the lever. Now, put a bonus on top of that lever. They might pull one of those levers, two of those levers, all three of the levers. I don't know. Because wow.
And they can change that lever
every year.
That's the renewal rate we're talking about. The levers. They can change what those levers are and what percentages of those levers at their discretion. They're not going to call you up and call me up as the agent and go, guys, we're thinking about, no. They're going to change it or not change it, one of the two. And
now I'm going to play the agent. I'm going to play the unscrupulous agent. Okay. Well, Mr. Jones, you don't need to worry about that because, see, they have different strategies, and we can move the money into the different strategies, and we'll capture whatever's doing the best. And as soon as I hear that, I ask them where their crystal ball is, because how do they know what's going to return the best? How do they know what the future holds? How do they know what's going? And I can promise you this, that 99% of your customers probably have more money in their checking account than those agents have in theirs.
I totally agree with that. Now, the 1 year point-to-point applies the same if it was a 2-year option or a 3-year option. A snapshot from contract anniversary date to that renewal date, correct?
You basically start to finish. Your start to finish could be 1 year, 2 years, 3 years. The longer that you'll take the hedge, the longer that you'll take the point-to-point, the more upside you'll be able to.
Because they're buying the options cheaper, correct?
In theory, capture. Because what if you go up 2 year, if you have a 3-year reset and you go up 2 years and the 3rd year you collapse?
Right.
You could get nothing in theory.
Right.
So, here's the kind of a rule of thumb. You buy it for what it will say it's going to do in the contract, not what it says it's going to do from the insurance agent.
Right.
Or the investment.
Right.
Okay. What's the insurance company say they're going to do for me? It says, well, they'll do this. That's what it's going to do. Anything other than that's gravy.
No, I totally agree. And at the time of this taping, and I know Mr. X and I, if you're viewing this on the Fun with Annuities YouTube channel, I mean, we look young and vibrant. I get that. I mean, that goes without saying, right?
You must have a very good filter. Yeah,
exactly.
Really
we do have editors and makeup people. But at the time of this taping, there's over 750 index options with indexed annuities. And this is my favorite part, over 50 indexes, most made up out of midair. And we talked about that on the last
made up out of midair because it's cheaper to buy the options in those made up indices than in the S&P, the Dow, or the NASDAQ. And so for the insurance companies and for the attractiveness of the product to be out there, they have to shop other ways to create return so they can buy it at a cost-effective level so they can make the product look attractive so you buy it. I can think of one right now. We won't mention any names.
Nope.
And they came out and said since inception, if this would have been in inception, it's never, ever, ever had a down year. Ever.
Mm-hmm. Great.
The index never, and Stan, you know exactly what this is. The index never existed, and it still hasn't returned positive. And it's been what now, 10 years, 12 years?
Mr. X, I've never gone a year without gaining weight. I just want to throw that out to you. That's the same thing. It's ludicrous. Hey, I talked about the 700 plus index option strategies. In today's podcast, we're going to go over 2, which means we have a lot more podcasts to go.
Thank you.
But
thank you.
The other one that is one of my favorite, not favorite from a recommendation standpoint, but the one that I hear a lot in the Bad Chicken Dinner seminar, and this typically is the rookie agent that just learned about indexed annuities. It's the monthly sum, Mr. X. Can you help me with can you explain? Because here's the pitch. I get a call the other day and the guy says, I went to the Bad Chicken Dinner seminar and I laughed because everything he said, you said. And then Stan the Annuity Man, America's Annuity Agent, he said that there is a potential 36% upside for the year because each month I can get up to 3%. 3 times 12 is 36, Stan the Annuity Man. And I just, after I laid down on the floor and you know, was sucking on my thumb like an infant because I went into just a reclusive moment, then I explained it to him. I need you, Mr. X, to knock the cover off of that monthly sum nonsense.
It is probably literally one of the worst strategies you could ever pick. And I know agents will argue with me and fight with me because they got lucky that the market went up for X, you know, and they got lucky. Like 1% of the time. Okay.
Explain the other 99.
Right. When you build a pyramid, do you put the fat end on the bottom or the fat end on the top?
Hopefully on the bottom there.
Right. Well, think of the monthly sum as having the pyramid built the other way. And here's why I'll go that with you. And I'm going to grab a piece of paper because I like to scribble. And
well, you can't show the piece of paper, Mr. X.
Well, I'm not showing that I do it for me.
Oh, well, that's good. I mean, I understand that the college years took a toll on your brain, so
it makes me think good. So think of it this way, okay? We'll use your example with 3% monthly cap. Here's what they're saying: you can make up to 3% a month. Anything over 3% in 1 month, you've capped out. That's it. Okay?
Market goes up 12 in 1 month, you get 3.
You get 3. Great example.
Got it.
Okay. What I didn't hear in that sales pitch is, what's my downside, Stan?
Oops. Whoops. Wait a minute, Mr. X. I thought indexed annuities had no downside. Explain.
Well, let's talk about this. My downside on a monthly sum contract, as they call it, is unlimited. You're not going to lose your money. You're just going to lose your return. Let me explain the difference here real quick. So let's take it. The market goes up. You said 10% in 1 month. We get 3. The market goes up 10% the next month. We get 3. The market goes down 10% the next month.
What do we get?
We're minus 4.
Because it was minus 10 that month. In other words,
unlimited
downside.
Minus 10, which wipes out the plus 3 and the plus 3. That takes us to minus 4, correct?
So the unlimited on the downside, cap on the upside, right?
Correct.
Yummy.
So now this gets fun. Let's say the next 8 months, we do 0. We're flat.
Uh-huh.
The last month, we do 25%. Santa rally. Just crush it in December.
You get 3.
You get 3. We're -4. I finished the year at -1, but the market was up 21%.
And you get 0.
And you got 0.
Now, indexed annuities are principal protected. The options, if they expire worthless or out of the money, as they say, then you're not going to get anything credited to your account. But monthly sum is, to me, that is, if Ted Bundy, and I'm assuming people consider him guilty at this point, if he was an annuity agent or Madoff was an annuity agent, they would be selling the monthly sum.
Well, I mean, it's just, I think the easiest way to think of monthly sum is this. Your monthly upside is capped. Your monthly downside is unlimited. When you add them all up at the end of the year, you ain't never seeing 36%.
I love the pitch though. I'm like, and then we go, well, what if the cap was 2? It would be 24%. I'm like, oh my gosh. I can hear you getting dumber through the phone.
I hear the echo.
Yeah, I mean,
it's just,
you're the guy, you're the mark, you're the bullseye.
He found him. He found him. I put 30 people in the room and I found him. Bingo.
And not only that, Mr. Jones, we're going to give you a 25% upfront bonus, plus you get a potential 36% per year annual return.
Yeah.
Fantastic. Doesn't work.
I mean, let's go back to the 100 pennies in the dollar. Let's say you put 100 pennies, you put $100,000 in there and they give you a 25% bonus.
Right.
Right out of the gate, the insurance company only has $75,000 to invest. Because they gave 25,000 away. So they're investing 75,000. Insurance companies make what, 5, 6, 7% on their portfolio on a great day? Right now, it's probably worse.
It's probably two to 4, honestly.
How long does it take for them to recapture $25,000 at 4% on $75,000?
Disclaimer, everyone. Indexed annuities are great products. They're fixed annuities. They're regulated at the state level. They were designed and introduced in 1995 to produce normal CD returns, typical MIGA type returns. If it sounds too good to be true, it is every single time. Unfortunately, and Mr. X and I do not blame the carriers. It's once they give the product to the agents and the wholesalers that are pitching it to them, that's when things get out of whack. That's when the stories start getting way out of whack. And I don't think there's a way to regulate that, Mr. X, really.
It's not the product. It's the way the story's crafted.
I agree with that.
The product is static. It doesn't move. The person presenting
disclaimer, Stan the Annuity Man, America's Annuity Agent, sells millions. I'm telling you, tons and tons and tons. Agents will call me, I don't know why you hate annuities. Why don't you sell? I said, dude, I sell more than you do in a day. In 1 year, I sell in a day. Because I sell them correctly, telling people you're not going to get market returns. By the way, on a side note, if anybody is talking and says the word market or stock in the phrase with indexed annuity, they better have the proper licensure to say that, because they're not market products. They're not securities. They're regular fixed annuities.
In my years of doing this since they first came out in like 94 till now.
95.
You have a chance of stock market-like returns. No, you don't.
Period.
Agent tells you that. He is so full of it, and he's wanting to see if you're the one, and now you've been educated, you're not. Here's what it does do. Here's what an indexed annuity will do for you. It will give you a better than average chance at a better than average return.
Yep.
That's it.
Yep.
I don't even want to equate a number to it. It's just a better than average chance at a better than average return. And here's why. With the way that the 10-year note is right now, and with the way the market is right now, everything's kind of depressed return-wise. If you look at fixed income accounts, they're pretty low.
At the time of this taping, absolutely, yes. Look at the date of when we were doing this.
So indexed annuity returns are going to be less than what they were. Now, if the 10-year note gets really, really high, gets into them 5 and 6%, then guess what? Indexed annuity returns are going to be a little bit higher because they'll be able to offer more. It's like a big teeter-totter. That's all it is.
We're old enough to remember what a seesaw looks like. I'm assuming that some of our clients and the people that are tuning into this understand that. I want to jump into the last couple of topics, which are, I get a lot of questions about this first one because the TV ads are rolling. We're not going to mention the name of the companies, but I call them copay annuities. In the industry, they're called buffer annuities. And to me, this is what happens when interest rates are low. Annuity companies and brokerage firms create products out of midair to attract money.
Opportunity.
And you know, they just do that. And it sounds too good to be true because it is. But these buffer products, Mr. X, what they're saying is you're going to get a little bit more upside than an indexed annuity, but you share in the downside. Some of them will give you the option to share in 5 or 10 or 15% of the downside. I call that a copay annuity. And I'm going to tell you this right now, Mr. X, the first phone call that eager agent that sold that has to make into the client and say, oh, by the way, it's going to cost you 10% because the market went down. That's not going to be a good call. And I've always said this. I have cowboy boots older than the majority of agents and advisors and registered reps in the business. They haven't seen things go down. I mean, it's hilarious. Give me your take on these buffer annuities, because they've kind of taken the brokerage industry by storm, which means that if those cats are selling it, and I've been there, Morgan Stanley, Dean Witter, Payne Weber, UBS, if they're being told to sell it, watch out.
Well, here's what I don't understand on the buffer annuity is, if I'm going to participate in some of the risk, why not just have a well-balanced portfolio, pay less in fees, and you're still in the same boat?
And not have them be able to change the rules.
Right. That doesn't make a lot of sense to me. I would just have a better, properly allocated portfolio that diversified my risk to where my drawdown is, going to be somewhere in that range based off of my allocation.
You know why, Mr. X? I just got the best correlation of all time. Because people love packaged products. Down here, I live part of the time.
Better. We'll call it bundling. I can bundle my cable and we'll call it bundling.
Well, and your comment about well-balanced portfolio just hit me in the head. And I live in a couple places, West Coast and East Coast. But I'm living on the East Coast right now, and there's a place called Rooms to Go. And Rooms to Go is a place you go in, and you can buy your whole entire living room. The tchotchkes, the table, the couch, the chair, the paint, everything. So for the designed challenged out there, you go into Rooms to Go and say, I want that bedroom, and it's the whole shooting match. To me, buffer annuities kind of fall into that category of the person's like, I'll just buy it and get it done in one place. Wrong.
Well, I see it in my head when you're sitting down with the representative and they're like, look, we'll put the stuff in here. Look, your upside is whatever it is.
7%.
But the beautiful part about this is your downside is protected. It could be 5, 10, 15% protected. So we already know what our worst case scenario is, and our best case is this. And if we just keep knocking it out of the park, we won't get as much, but it'll be buffered against our downside. And I totally see the sales.
Oh, it's a great sell. Mr. and Mrs. Jones, I'm here for you. And I'm acting as a fiduciary, and I want to buffer any losses because you've worked so hard for the money that this package product, will give you a little bit more upside than the index annuity that the guy at the Bad Chicken Dinner seminar pitched you, which, oh, by the way, he's not licensed to talk about this buffered annuity. How you like that voice? So let's do this. And you can share. There might be some times randomly, some years that you might have to share in the downside. I can hear that pitch. If you turned off your morals at the door and and flip the fiduciary sign at the door, it's an easy sale.
Well, here's the best part. Tell me when the down year's coming, when I might have to draw, where I'm at financially at that point in time when that down year comes and what happens. I mean,
here's my thing. And I always tell people this because I've been on the other side of the table at these big firms. Not everybody needs an annuity. You need an annuity if you want to transfer risk to solve for primarily principal protection or lifetime income. Okay, that's the primary two. You can also get them for death benefit or long-term care. But the primary two are principal protection, income for life. But if you're sitting with a person that's a registered rep, wealth architect, master of the universe, and they're selling you packaged products, you need to ask them, what are you doing? What am I paying you for? I thought you were going to manage my money, right? Am I missing something there?
Well, no, because I laugh because I'll never forget one time when one of my agents, we were going through a client's portfolio. She had $2 million of bonds and she was getting charged 1.5% wrap fee for the age
On a bond.
to manage the bonds.
Which leads me to one of the biggest things that blows the top of this green hat just goes straight to the ceiling, is when I hear agents, and we covered this on the last podcast, putting a wrap fee on an indexed annuity.
Yeah, it's just.
It should be illegal. Mr. X, it should be illegal.
I agree 100%. You're not doing anything. By the way, is you're supposed to review that policy every year with your client anyways. You were paid up front for the life of the contract for you to service it.
Exactly.
I just had that discussion yesterday.
But a lot of the major brokerage firms are putting these wrap fees on that. I don't know how compliance signed off on that. I know the people in the compliance departments at these places because every office had one. They're the baddest people on the planet. They do not take any gruff, and it's their job to make sure it's in the client's best interest.
And
within
everyone
each
answers
brokerage firm.
Everybody answers to the compliance department. The compliance department only answers to the SEC.
And I'm trying to figure out how they sign off on that, if that's just corporate wink and nod saying, yeah, let that go through. Because people have to understand, in the brokerage world, and I was there before wrap fees. I'm so old. I was there before, when you did a stock order, you put them in a vacuum tube. The vacuum tube was shot across the office to the secretary input order people. They took the paper and then put the order in. That's how old I am, Mr. X.
And that was high technology.
That was, and we had one computer. There was 4 of us sitting, and we shared one computer. That's how, I've seen it all, okay? So, but there was a transition, and one of the reasons that I exited the building at the major wirehouse is they wanted everything wrapped. Like your bond example, they wanted everything wrapped. And people say, well, they're just managing, they're on my side of the table. There's an ad out right now. We're on your side of the table because, we charge a fee, and if it goes up, we share in that. No, the reason that brokerage firms want that to happen is so that they can project future revenues.
Well, they get paid whether it goes up or down. That's something that everyone has to understand. And so when you see those ads, well, we only get paid if your account goes up, we make more. They fail to mention that if your account goes down, well, they still get paid. They just make a little less.
It's that, again, people that, fee-only advisors love fee-only advisors because fee-only advisors do not sell product. Fee-only advisors, not fee-based, difference. Fee-only advisors are definitely sitting on your side of the table, but still, if markets go down, they're still charging their percentage. Nothing's perfect, but I'm saying if you're going to manage it, and I know some really good fee-only people that if you want to contact me at theannuityman.com, I can point them to you. But I think we covered that. One last question. This might take us the whole shooting match.
Okay.
Because I got more questions after you came on. Well, first of all, they wanted to say, he sounds so fantastic. Is there any way that we can see his face? I'm like, no. I said, in fact, he's wearing the mask, even when we're off camera. That's how much he likes the mask. So the answer
I have a great tan. You should see the crazy tan I have with the mask.
For the people that are listening to us on the podcast, he's got an AC/DC t-shirt on. So obviously, me and him see eye to eye musically, which is good. AC/DC, for all the people out there, it's a rock band. But here's the last question. Here's what I got a ton of stuff on because this is what's being pitched out here. Mr. X, what's better? Stan the Annuity Man, America's annuity agent. Indexed annuities or indexed universal life? Hello?
I'm laughing under my mask.
Well, here's the pitch. Here's the pitch, and I've got nothing against people that sell life insurance. In fact, I have millions and millions and millions of dollars of life insurance on myself. So if I die unexpectedly, my wife is the first one to look for. But life insurance is great. It's the best return on investment you'll never see, ever, because you're dead. But what agents are selling out there, and this, by the way, this pig has had the lipstick put on it for 30 years. They just keep changing the name. And what they say to you is this: you lump sum this money into the life insurance policy, and you get tax-free income, Mr. X. Tax-free income. And I'm like, wait a minute. No, that's a loan. All loans are tax-free. You're getting a loan, LOAN, off of the life insurance policy That is not tax-free income. Can you please knock the cover off of this?
Well, let's address a few things. So we got to go backwards to go forwards.
Please do.
There was an old insurance product back in the day called single premium whole life. Might have been the greatest tool ever invented. You put, say, $100,000 in, you got maybe like $110,000 of life insurance. So you didn't get a lot of leverage.
Right.
But what you got was a lot of cash value. And the cash would accumulate, and then you could go back and borrow the money out at what they used to call a zero wash loan. Anything above your principal, I could take the cash out. I had no interest, no tax on it. Genius. Well, take a wild guess who hated the idea of taking money out and not getting any taxes.
Who would that be, Mr. X?
That'd be the government there, Stanley Annuity Man. And so the government went in 1986, and they created something called TAMRA, the Technical and Miscellaneous Revenue Act.
Right.
And they changed the law, and they created what's now called a MEC, a modified endowment contract, or a non-MEC, non-modified endowment. So basically what it said is section 7702 of the IRS code said that if you put money in over 7 years, you pass the non-modified endowment, and then you can take the money out tax-free and do all the kind of stuff you did before. So what happened was a lot of the agents transitioned into selling annuities. Their thought was, well, if I'm going to sell modified endowment, a MEC, I'm just going to sell one that doesn't involve underwriting, and I don't have to wait 60 days to get done.
Right.
And that's how the annuity business kind of took off. So let's get back into the IUL. This concept has been around literally
40 years.
Forever.
Yeah, I remember it when I was in the business back in the day when I was skinny and cut up like a raw athlete. Back in the day.
I mean, it's been around since the day I got in here, which was a long, long time ago also.
Yeah, it was. Yeah, it was.
And so here's the big sales pitch that's going on right now. You can go Google and look at lawsuits, and you'll see them. Oh, they're coming fast and furious. So first of all, what's better, an index annuity or the insurance? It depends.
Apples and oranges.
It depends what the need is, okay? If your need's to cover an obligation, well, then you need life insurance. If your need is to have income for life, well, then you have to really look at, and you're gonna get a lot of hate mail on this one. You really have to balance it out of the guaranteed versus the projected. Because here's how they do with the IUL. If you're older, let's say you're 70, okay, that's not old at all in today's world.
No.
Say you're 70 years old. There are people out there telling people to cash in their IRAs and pay the
taxes.
Pay out over a 5 to 7 year period, okay? Create a non-modified endowment, hang on, and let it accumulate, and then you can take the money out income tax free. And if the index annuity does its average return, yada, 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 and they'll show you the illustration, and it's all bull, you know what? Because this is the first thing I try to explain to people. Stan, when is the last time the market went up in an average?
Never.
Ever. Never, ever.
Never.
Never, never. It's never returned the same return twice, back to back, ever. So they show you these returns at, 6, 6.5, or whatever the rule is now, 6.83 is like the max they can show, whatever it is. So they show you, look, it goes up every year at 6.83, and at age 78, you can take out $100,000 a year and blah, 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 blah. What happens if when you start, it goes 0, 0 the first 2 years?
You're done. And what happens if they raise the internal cost on that?
You're done. Everything changes. So I caution every listener, and for all you agents that are going to send the hate mail,
to me, this is great, Mr. X. You're going to create the firestorm, and I'm going to get the flood of email, which is fine. Bring it.
Now I know how your wife feels in reverse. You create the firestorm, and poor the wife's got to think. But I want everyone to think about this. So if you go Google, you can go Google IUL lawsuits. Don't get me wrong, index annuities have their share too, but the IUL one is incredibly dangerous, and here's why. Because they're having people, the plan was to cash in their IRAs, pay the taxes over a certain amount of time. Some of the companies were doing it in 3 years. Well, you got to do 7 for the. So what they do is they manipulate the insurance contract. So they make the face amount real high,
Oh,
They
my
took the
goodness.
money in to create the non-modified endowment. Then after 3 years, they lower the face amount back, the insurance amount back down. Sorry, I was getting into agent lingo.
But when
They
you go
lower
down
the
that
insurance
rabbit
amount
hole,
back down so the policy won't implode.
oh,
They've materially changed the contract. I have a strange feeling the government's not going to be too happy about that.
here's the thing. You know, you buy life insurance for the most death benefit you can get for the least amount of money. It's the best return on investment you'll never see. If you buy it for any other reason, in my opinion, than legacy, okay, tax-free lump sum death benefit to your beneficiaries, then you're being sold and you're buying Lamborghinis for your agent. You'd be better off just buying the Lamborghini for him.
Like
Or
I
her.
said, I think in some cases it may work, and we might differ a little bit. In some cases it may work, but in some cases, but the way that they sell it to anybody 65 and over, oh my gosh.
I know there's asterisk cases for entrepreneurs. I get all that. But that's not,
100%.
they're selling this to the masses.
Yeah, and and here's what they do. They will run you a spreadsheet that says, here's what we put in, here's what the return is, here's how it accumulates, here's what you can draw for the rest of your life. And I'm here to tell you that it's 100% bull. You know what? It doesn't work the way it's shown on the paper.
It's not contractually guaranteed.
No.
You own things that are contractually guaranteed. Mr. X, of course, we could keep going. I mean, that's an understatement. And obviously, I'm going to hold you to this. Are you going to come back? Because I know the questions are going to come in. We need you back. Can you?
I have to come back because I can't wait to see these questions.
Well, you know, we might.
I promise you this, for everybody listening, Stan and I have created an absolute firestorm today with that topic. You're
Absolutely.
more today than usual.
Yeah, and I recently had one of the top IUL salespeople contact me, want to be on Fun with Annuities, and we're thinking about it. I don't know he wants to step into the ring with someone like me. That's he's got to be real careful.
Here's one other part too that they don't tell you is that, first of all, I don't know what the return's going to do, and you might be able to accomplish with traditional life insurance versus IUL.
Sure.
Same exact thing that you want to do.
Right.
The second part is what they can do is in the indexing strategy, they can hide the mortality. That's fancy speak for they can charge you more than a traditional policy will because they can bury it in the mechanism.
Don't buy the sales pitch dream because you're going to own the contractual realities. I've said that many a time. Do you have any, and of course you do because you're, Mr. FIA-X, but do you have any words of wisdom on the way out of this wonderful podcast, Mr. FIA-X?
Do your homework. No, legitimately, do your homework.
There's
no perfect thing. And I think Stan will be the first person to tell you, look, the annuities that Stan works with or that I work with or what we do, it's not a panacea. It's not going to, be a be all end all cure all. But when they're placed properly for the proper need,
sure,
they do exactly what they're supposed to do.
Right. They're contracts.
They're contracts. It is a contract. Where the problem comes in is not the company, not the product.
Correct.
It's the person that represents it. Do your homework. Ask your questions. Get a worksheet together.
Run it past Stan, the annuity man.
Well, that's a pretty good resource, isn't it?
Yeah, go to theannuityman.com. You can, the top left-hand corner, you can book a call with me. Yes, me, not Junior Stan or Stanetta or Stanielle. Stan. And I'm going to give you 30 minutes of my time, and we're going to tear into the facts. So, hey, Mr. X, it's been a pleasure always being in your presence, even though it's virtual. I really appreciate you being there.
Anytime.
And I
actually do enjoy it. I hope we're teaching some people some good stuff.
I think we're saving people from some really bad decisions.
I was going to say I don't want anybody to step in it and then,
Yeah.
I guess here's the one good downside. If you did step in it with annuity, you know exactly what it's going to cost you to get out of it.
Correct. That is correct. So with that little nugget of wisdom, I want to thank everybody for joining me, Stan the Annuity Man, America's Annuity Agent, on America's #1 annuity podcast. And it's the #1 annuity podcast on the planet, Mr. X. And it just happens to be called Fun with Annuities. See you next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.